What time is it? Good morning. It's 7:59 and a minute early. This is Vince Lanci with the Gold Fix. Today, we want to talk about a couple things, not all gold. One of them plays more to uh, volatility as it relates to the stock market. But let's start off with gold because that's where it's at. We have something on the radar that's going to happen soon. Gold is ready for a volatility expansion. Now, on your screen to your left, you'll see some technical numbers. And on your right, you'll see the 4 hourly chart with no drawings of any kind. That red line going across is a stop level for me to get short. It's an alert. It's not actually an order. Okay. First, starting on the left, technically, that's a technician's list of numbers. I highlighted 1294.30 and 1288. Now, those numbers have been with us for some time, although not exactly those numbers. They are downwardly sloping hourly for the 1294.30 and upwardly sloping hourly for the 1288. And I highlight them because those numbers come very close to something that's on my radar for the last 2 days, 3 days actually, running now, and that's a 4 hour VBS signal. These are very good and very powerful usually. If you're right, when you get a signal, you know you're right within 4 hours. And if you're wrong, you're usually stopped out and free to move on, divorced from your position in within 3 hours, actually. So the reason I bring these numbers up and the reason I highlight those numbers on the left today is because they coincide so nicely with these Bollinger, but it's not Bollinger Band, but Bollinger Band is my final trigger levels on the VBS. Now, before I get into that, as an active trader, I ask myself questions all the time, and when I fail to ask myself questions, that's when I get in trouble. So the question I asked myself this morning was, did I pick those numbers just because they fit what I already had in mind? Was I projecting what I wanted to be the important numbers onto the technician's numbers? A Sixth Sense kind of M. Night Shyamalan movie. I see what I want to see. And the answer is there's almost always an ocular regression, if you will. But in this instance, my information is semi-scientific, and that is I've been following these these hourly trend lines. Those numbers have been important to me as I've been rising. If you listen in the past, I've been saying an upwardly sloping trend line is going to run away from us. It'll be less important. But there's another one coming in at 1288 today, upwardly sloping trend line that isn't running away from us. So why don't I put not necessarily exactly the technician's trend lines, Michael Moore's trend lines on, because I don't know what they are. That's his. You can infer it, but I'm not going to do that. I'm going to put on his trend lines. And I'm going to put them on the 4 hourly. These are drawn on an hourly chart. Okay. Actually, I think I drew these on a 4 hourly, but I drew them on a 4 hourly because that was important to me. But I do look at the hourly chart as well. But when you extrapolate them on the hourly chart, they actually come in very similarly, but not exactly where his numbers are. Now, the three upwardly sloping lines I've had for some time, going back for maybe 2 weeks now, and you can see the very top one I have here. That's the one that I said that has become less important as the market is now traveling sideways under it, and it's certainly not a trend line that is important, at least right now, anymore, because it's the word I think will be dissipated in importance as the market's kind of ignored it in favor of going sideways and making people fall asleep, it looks like. But these other two trend lines here, I think they come in similar to this uh, well, actually not similar if you look at it, because he's probably got a line going underneath where my cursor is. I'll try and just draw crudely uh, a crude approximation of what I think he might be looking at. And again, I don't know, but he's looking at a line that comes in at 1288 today. It might look something like this, right? I'm not going to leave this up there because that's an arrow line, but you can see what I'm looking at here. He's got a that's an approximation, I think, of his line. uh, uh, and I'm not going to leave it there. But that's a line that I did actually have on an hourly, but I didn't leave it up there. But anyway, I think the key here is once I take away these lines, and that line here, let me put that out there again. That line I drew across the top, I did draw that today. You can see it's a little darker because that line I think approximates his hourly line coming in on the left at 1294.30 with a downward slope, although it's on a 4-hour chart. So that's I think a line he probably drew from way back here to there. And on an hourly chart, it probably touches it a lot more. On a 4-hourly chart, it doesn't look that robust. But the reason we're sticking with the 4-hourly chart is because hide the lines and put up our final indicator on the VBS, and we have a very it's a word that's overused, but I'm going to say it, interesting situation. Interesting because we are in an unnaturally tight uh, uh, signal coming up. We're going to get a breakout from an unnaturally tight signal on the Bollinger Bands. Now, the VBS works about 50% of the time. I think I've said that several times. It actually should work less, but in energy and gold, it works 50%, which is actually uh, pretty good if you ask me. So I'm going to give you a clue. If I haven't before, I'll do it again. I'll give you a clue to one of the indicators. One of the indicators that leads you to start paying attention is when the blue line here gets less than 50% of the red line. And we have had that. And that's when I warned a couple days ago that we're going to have a breakout. I think I tweeted that out. We're going to, a breakout is imminent. And all that means is just be ready. It doesn't mean, if we don't have a breakout, I'm wrong. It just means be ready. But the market decided to flatline some more. And in fact, we had, if you look at the hourly, yesterday, if you traded the hourly VBS, you would have had a buy signal here, and you would have, if you were smart, if you were genius, you would have sold it here, but you would have been risking down to here. So you would have been risking one to make one, and I did not participate in that, especially since it was the first hour of the day. I'm not a huge fan of those, but you'll notice that we really, on an hourly basis, you had a little trade there. If you were willing to play risk one to make one. And now here we are tightening again. So you're getting some nice cycles in the hourly volatility, but nothing that's sustaining enough to spill over into the 4-hour volatility. And here we are staying on the 1 hour for 1 minute. Here we are tight again. All right. And there's a lot more to this, but I don't want to take up too much time because we do have some information to get out other than these active trading signals. But I think they're important today. Today is a day to today's the day to lose money and learn. How's that? Um, okay. Uh, the goal not being to lose money, but to be prepared. The VBS is very tight today, and it is so tight. And you don't see this, but I do. It is so tight that we can have a final signal to get long, even on a candle that finishes within the Bollinger Bands, which is very unnatural and almost always leads to a first way, wrong way type of trade. And by that, I mean volatility is so low, so flatlining, so downtrending on the 5 and 20 day that it's almost like the bottom and top line of the Bollinger Bands are going to cross before the market moves. Now, that doesn't look obvious here, but I'm exaggerating to make a point. So what I'm giving you today, just to cut to the levels that actually are very similar to last night, my levels were 1294.28. Look to the left, that's 1294.30, and 1288 spot oh 01. And lo and behold, these numbers I got this morning from Michael Moore are pretty much the numbers I had last night. Now, it gets a little bit more freaky from there. Not only are those numbers important for him from a trend line support and resistance or momentum perspective, and they correlate nicely with my own numbers, which now have changed. I'll tell you where those numbers are now. Um, those numbers now are 1294.52 and 1288.53. That's spot gold. Add 50 cents for futures. Pretty much Fed futures are converging with spot right now, and you should be looking to April in a day or two. But right now, I'm going to be looking to get long on a 4-hour settlement above 1294.51 or below 1288.53. Now, the reason I say this is a hazard is the first way, wrong way in my tweet I put out there today was because when you have Bollinger Bands that get this, just the Bollinger Bands alone, forgetting my system, when you have Bollinger Bands that get this tight, you frequently have first way, wrong way. And the reason that's not a big concern is because they're so tight that your risk reward, that your risk, not necessarily your reward, your risk is so unnaturally tight that you're, risking $1, risking 50 cents in a market that can move $6, which is crazy tight as stops go. So that's why on days like today, I would not be surprised if I get let's say this were an hourly system for a moment. I would not be surprised if we sit up 1296 in the first hour and it gave me a buy signal and I got long and I was risking $1 and I got stopped at 1295 and the market proceeded to scream to the other side to 1288. This happens frequently when we get unnaturally tight Bollinger Bands, which is why I say first way, wrong way is frequent. Now, another way to play this is to really, really look at it from a technician's point of view. If I have a number of 1294.30, looking at the left, and I have a number of 1288 on my volatility system, and a technician's numbers coincide with that, then it's very possible, very likely that if you believe from your volatility system, first way, wrong way is very more likely than normal, and you have these tight support and resistance numbers that probably come in. And look, as one of the guys yesterday who I had a chat with, he's like, triangles are death, especially in precious metals, he implied, because you just ping pong back and forth, and symmetrical triangles uh, uh, kind of do nothing for you except make you pay attention. And we were talking about triangles as well. So what I'm getting at here is that why not look at the Bollinger Bands today? This could be a great day if you're an RTM regression to the mean type of trader. We get above 1294.30, we spend an hour up there, and then we reverse through it. You should look for 1288 if we get above 1294.30 and then back down. You should look for a ping pong in what's probably an hourly trend line wedge or triangle. Look for that because I certainly am. My hope is, if I want to have a clean signal today, is that the hourly will trigger after the first hour. And if the hourly triggers, let's say, higher after the first hour, then I will probably uh, enter 25% of a position that I would want to put on. And then if the 4 hourly hits, meaning the snowball's enlarging, the volatility is expanding from the 1 hour and like a virus infecting the 4 hour, then I would add more and probably put more of my position on after the 4 hour hits, depending on how high the market is. So if the market were to close, so just back to this, if you're sticking with the 4 hour here, and the market comes in and settles in the next 47 minutes, because that's what we have left in this 4 hour bar, the next 47 minutes above 1294.52, all the other signals are in place. All the other indicators are in place for you to just say, buy it. Now, you don't want the market to settle in 46 minutes and change at 1300, because then your risk reward is just blown out. You want the market to settle 1296 and a half, 1295, because that's a nice little setup there. You could say, I'm going to buy it because it settled at 1296 in 46 minutes. And then I'm going to stop myself out at the number that Vince gave me, 1294.54, 51. Or you can change your stop to be a little bit lower because you have a technician's feel. Maybe you say, I'll use the low of this bar, whatever. But the point is this: you have a stop built in, 1294.50. And if the market settles 1296 and change in this hour, you should buy it. I'm telling you, you should also look at all of your financial situation and your tolerances for risk reward before you buy it. I should buy it because this is my system and I know how it works. I should buy it with a $2 stop, looking for a $3 to $4 gain. Um, if the market, however, comes in and closes in these now 45 minutes above 1298, I'm going to be a little bit annoyed because now I have to risk $4 to make 8. and with an average daily range of about $7 in gold, uh, I find it hard to believe it's a low delta that I'm going to get that $8 move, and if I do, I may as well get a $20 move. The nature of the way the gold market moves. Anyway, so we spent enough time on this. I wanted to be very thorough up front in that I'm looking to buy gold above 1294.51 after the first hour, and by the book after the first hour or after the first 4 hours. I don't like trading the first hour on an hourly signal. I will trade the first hour on a 4 hourly signal. If the market comes in and reverses below 1288.50 on a 4 hour close, on a 4 hour bar, I will look to be short that, and probably short that with a vengeance. I think my risk is going to go like this. One, because the Bollinger Bands are so tight, and I am getting a violent, potentially violent move that could be first way, wrong way. I'm going to keep a lot of powder dry because I'm leaning towards making sure that I can trade both directions today. The market goes above 1294 and change and settles, and I get long, and then I get stopped out. Then I want to be ready to sell it below 1288 on what could be a trend day. If you look at Stottlemyer's old market profile lower, and I want to run that into the ground. So if I trade two lots in any particular position, I'm going to trade one lot higher uh, because I think there's a high chance of blowing through my stop and going lower because I want to trade that one lot lower. Um, uh, uh, Volumes actually vary from that. I'm just giving you simple numbers for ratios. And the final thing is today could be two trades that I get stopped out. I say first way, wrong way. It could be both ways, wrong way. And then we have another sideways move. I don't think that's going to happen today. But if you think that's going to happen today, that it's still just range bound, then by all means use these levels as levels to fade the market. Enough about gold in particular. I want to go through a couple things I thought were interesting. The second thing that comes in from the technical analysis, it's a little hard to read. I kind of clipped it very smallly. So let me read it to you. Note, although the upper and lower short-term lines, the ones I highlighted in yellow, are well formed, the fact we have traveled far into the apex of this consolidation warns these have a higher likelihood of failed breakouts. And then I read that, and it was like angel singing to me. A technician has come to the same conclusion I have from a completely different perspective. He just said what I took 10 minutes explaining to you in one sentence. And that is whenever you have a triangle or trend lines that are converging in opposite directions in a wedge formation, when you get past the apex, or my interpretation is the midpoint, actually the two-thirds point, failed breakouts or reversals are highly likely. So thank you, Michael Moore, for coming to the same conclusion or the same identifying the same risk from an entirely different uh, 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 discipline. All right, next, we're throwing up here the dollar gold relationship again. This is a better version of Gunlock's slide, where he's basically saying the dollar made highs here. He's referring to the DX. DX made highs here with this open interest. Now the DX is making lower highs with the similar open interest. I don't put a lot of credence into that because it doesn't measure if there's new flows or less than new flows in. But I wanted to say that again because that brings me to this chart, and I did a little experiment. One of the things that Gunlock did was uh, he showed, he's a technician, and I think he's a technician when he's rationalizing positions he already has. But that's completely conjecture. In fact, it's probably speculation. But he basically said from high to low in December of 16 to say December of 17, we have retraced two-thirds of that, 61.8%. And the dollar has barely touched that, if not at all, and bounced off of it lower. So his point is that if you're looking at Fibonacci, which I don't, I know that I'm rationalizing position when I do. You could say that the market is bearish. I want you to look also at this this trend here, you have a nice little trend here. This could continue in an orderly fashion up, or even have a blow off top before selling off. And that's his Fibonacci. That's the orange lines. Now ignore the orange lines, okay? And I want you to look at the dollar. Again, I guess this is technical analysis, but I don't look at it as much, what I'm about to talk about. He draws two arrows. One is the dollar index making higher highs, with the RSI making lower highs. And that's, a lot of people will use a nice fancy term of negative divergence. We used to just say it's a non-confirmation. The market's making newer highs on lighter volume. The market's making newer highs on less participants. The market's making newer highs on less interest. That's what RSI or a stochastic, a slow stochastic would tell you. And that's valid to me. That's a comment of participation. Uh, uh, MACDs also help in this sort of area, and it is technical analysis. But this to me is not uh, actually something I would put too much weight on, even though I love to put weight on these, because we're in a QT situation. That means there's less dollars floating around. So the dollar could be rallying with only one guy buying it. If there were only $1 left in the world, you could have much higher highs without much higher highs in RSI at all, because there's only one guy playing. I'm not really sure how RSI works from that perspective, but you get my conceptual point here. But the reason that I bring this up again is because I decided to do this in gold and put these side by side. That is not gold. I will put that up so we can see what I'm talking about. Okay, so here is the same chart for basically the same time frame in gold. Now, this actually makes Gunlock's point. If you look at my yellow lines, all right, look at this last two yellow lines on the right. They parallel the time frame that he's talking about in the in the dollar. You have an upwardly sloping line on the left, right, in the dollar, with a downwardly sloping line on the RSI. So you have higher highs without higher highs in the RSI. Now in gold, you have higher highs with higher highs in the RSI. That is a sign of fresh money coming into a market, and every time someone comes in, they're coming in as a buyer. That's not bullish in and of itself, but it does say that the strength of the move is not fading. And I actually, just to show for confirmation the other way, when gold did have its sell off in early 2018, starting in around April, a little before April, it went down and RSI went down. And when gold made its lowest low, the RSI basically made its lowest low. And so this actually makes Gunlock's point here. This is how a market acts normally, right? Higher highs, the RSI confirms this. It's when you get a higher high in a market and you don't get a higher high in the RSI that you want to pay attention. Now, the RSI indicator used to be very popular for all time frames, but now I think it's been outdone by other indicators like MACD and uh, and other systems that I'm familiar with, but I think are too complex, and I think too complexly and circuitously in my logic enough. I don't need anything more complex than what I have. But the RSI, I think, remains important when you look at longer time frames like weekly and monthly. So there's Gunlock's point actually made for him by looking at gold. So if you look at it, gold is doing pretty good relative to DX. Now, is that a comment on gold or a comment on the composition of DX? Probably a comment on both. It's 8:23. I have to cut this short. So why don't we get to what we're looking at today and our potential drivers? Capital markets globally remain subdued, as does gold. Stock markets are lower. The DX is flat, and it seems that early indications in stocks and VIX are pointing to fund managers possibly buying their hedges when they can, as opposed to when it's too late. And I want to bring this point up because we might extend this into the AM roadmap today. I want you to look, if you would, clear off my stuff here. All right. This is the VIX on a 1 hourly basis. I don't have time to go into this in too much detail, but here's yesterday. Yesterday, the VIX started out higher when the market was higher, and then went lower when the market was higher. That's more normal. And then got strong as the market was rallying. Dipped again, and then got strong as the market came off the highs. This is not normal behavior, or I should say, normative behavior. Here's the SPX during that same time frame. I'm sorry that I don't have both charts up separately, but here's yesterday. Yesterday, market goes up. Let me stretch this out a little bit so you can get a better view. All right. So the market opens up and the VIX went up. The market's flat for the next hour and the VIX went down. The market went down, the VIX went down. The market went up and the VIX went down a little bit. Actually, the VIX went up during this time frame, and then the market went down. So you could give the VIX a predictive characteristic yesterday, in that it led which way the market was going to go. I prefer to look at it like this, and I think many people should, is that the VIX has found support. But mechanically speaking, I think you're going to start seeing more and more managers, those that have survived the active manager onslaught, buying their hedges, buying their puts when they can, not when they have to. Now, the trade as a volatility guy, even more than a precious metals guy, for me is when I see volatility go up in a market like the stock market, which is a put skew market, which means volatility should come in a rally and go down in a sell off. That's not bullish or bearish. It just tells me to buy out of the money calls hedged, because either the market's going to go up and vol's going to expand, or the market's going to dump. And I'd say 5 out of 6 times that I have traded this, it has worked. And 9 out of 11 times that I have identified this, it has worked, even though I haven't traded it every time. So if you can be patient and you understand volatility, when the VIX rallies, and if that happens again today, if the VIX rallies and the market rallies, then seriously consider um, uh, yourself smart, or consider being long a 30 delta call or 40 delta, 20 delta call spread hedged. Because if the market goes up, you're probably not going to get hurt too much. If the market comes off, you're going to make a boatload. That's it for me. Again, haven't gotten to as many things as I wanted to, but that's the nature of how I conduct these class/meetings. So it's 8:26. I wish you a very good day. And today on earnings, Netflix is coming out with earnings, PPG is coming out with earnings, and you'll have the Philly book out, the beige book. Finally, the beige book basically which is a primer for the next FOMC meeting, focused on market volatility and trade, and opined that the shutdown wasn't having a negative impact on consumer sentiment thus far. They also expect GDP in Q4 to remain above trend, but off the highs. Again, Netflix and PPG report earnings today, and that's pretty much it. I'm Vince Lanci. I'll tune in tomorrow for the Gold Fix, and we can talk a little bit more about some reports that I have on gold and in a macro point of view. Cheers, and watch the levels.